Rakesh Arora now joins us this morning. Rakesh, what is the sense that you get of the impact that investors have because of demonetization? Do you think investors have digested this? It's now old news and they are focusing in on what happens after that?
Right, Pankaj. Basically, demonetization is largely a small blip on the growth trajectory. It's unlikely to change the course of our consumption pattern significantly. So I don't think investors are too bothered about demonetization. It's rather global events which have been driving the markets lower, and we have been seeing sustained selling by FIIs. And until unless that comes to an end, unlikely that markets can really move on despite a little impact from demonetization.
You've been speaking to investors. How has their view changed after this move? There will be a short-term problem. There will be a medium-term disruption. Do you think investors are taking it positively that demand would bounce back once we have a good currency back into the system?
I think the general consensus which is building up is that it's just 1 quarter or at the max 2 quarter impact on the demand, and unlikely to sustain in the longer term. When investors are willing to give P multiples of 30, 40 times to these companies, I think they are looking well beyond 1 or 2 quarters. So to me, and from speaking to other guys, it's very clear that demonetization is not the real driver of this market. It did, I think the impact of demonetization was factored on the first day itself. Post that, it has all been, FI selling which is driving it.
Right. If you look at the Bloomberg consensus now, or any, major consensus in terms of earnings, markets would be trading at about 15 times or probably 14.5 times 1 year forward. But that number will go down, you think, in the next 2-3 quarters? And that's why it would not be correct to just look at valuations on those basis?
In fact, there's a chance that numbers might get upgraded for FY18 because there will be a pent-up demand from FY17 which will get transferred to FY18. So I'm not really too concerned about numbers seeing a downgrade from where they are right now. And historical 10-year average is also around 14.5-15 times for the market. So market is now looking reasonably valued. I won't say it is deep value as yet, but it is reasonably valued. And as the reform momentum continues, I think investors will be willing to give a higher P multiple to Indian markets. And so, let's see how the GST rollout happens. And government has been also taking a lot of fast actions. So next 6 months, the reform process is going to define whether we go back to 16-17 P multiple, where the market was before this whole demonetization and the US elections made an impact.
Right. You look at Sensex EPS, you have, Nifty EPS, you've always tried to calculate it, estimate it. But, with this sort of demonetization that has come in, you would wait for the data to come in rather than just expect what will be the cut, what will be the disruption that you see. Wait for the budget because, they will speak much about what happens, what has happened about it. And on the basis of that, there may be some changes in a lot of tax structure, not only for individuals, but also for a lot of sectors. And that's why you would just wait till the March numbers to come out and then take a call on what's the EPS number rather than trying to predict what will be the downgrade now and then probably on the base effect, what will be the upgrade.
That is true, Pankaj. Basically, see, FY17 is where the numbers are more murky as compared to FY18. So I don't think anybody is valuing the companies or the market on FY17 numbers now. Everybody is looking to FY18. And from whatever we are hearing on budget, as you rightly pointed out, there could be a lot of tax changes. There could be incentives for the rural economy. So all these things point to a better FY18 as compared to where people were expecting it as of now. So I would not really wait for a confirmation as to where the FY18 numbers would. Markets are now back to 10-year averages, and the dips should be used to enter the market. because the reform process is going to at least boost our GDP growth from current 6.5-7% where it is to probably 8% plus.
Right. In terms of any portfolio, if you would look in the last 15 years or 20 years, one of the big contributor has been high-end luxury, consumption or consumer durable. Maybe if, AC was earlier a luxury, now it's not. But, that has essentially, seen a big PE expansion. There you expect a bit of pause. So there may be new sectors which may come up. There may be new sectors where you may see flows coming in. And the structural consumption story for India may just take a while before it plays out?
Yeah, so in the last 5 years, there has been a significant P rating for the consumption sectors because most of the investors were, flocking towards consumption as a safe theme. And clearly, the P multiples, which used to be around 20-25 time P, went up to 35-40. Even for some of the non-consumer but rather commodity kind of companies like cement and plywood or tiles, they were also trading at 35-40 P, which made really no sense. So this correction was always in the making, and I think investors are now woken up to the reality that these sectors can't really outgrow too much beyond where the economy is, and that is what is leading to a sharper than market correction in these sectors. And I think there could be still some more time correction which can happen in these sectors before they become reasonably priced.
Right, and when probably you would have started to cover any of these names like Havells, Crompton Consumer, or probably some of the other durable companies, they were trading at 12 times, 13 times, which expanded to about 30 times in the last 5 to 6 years. That 30 you expect to go back to 12, or about a 20, 25 or maybe 30% correction will mean that worst is factored.
So if we are expecting market to trade around 15-16 P multiple, these stocks can easily trade between 20 to 25 P multiple. They will always command a premium because no government intervention, and these companies have a free market to really operate, and most of these companies are free cash flow generating companies, so they will always trade at a premium to the market. And so 20-25 is the band, I think, where investors should be comfortable looking at these stocks. But 30 plus was in any case looking a bit stretched. Currently we are seeing expansion in multiple of some of the cyclical sectors like metals, etc. So our rebalancing is already on the way right now.
Right. We've seen banks and banking names. We basically got both sort of views. So most of the investors say that there will be asset quality issues, but others say that 10% retention in what money which comes in would boost the CASA, plus the rates in the system would go down. How would you look at these banking names? Will now it become a very, very specific run? Because earlier we were seeing all private banking names go up, all PSU banking names went up from the lows of Feb. So now it will become very selective. The one which can manage their asset quality will command a very big premium.
See, in terms of NPAs, if you look at, they are largely driven by metal and mining and infrastructure space. And I don't think, those sectors have been hurt at all because of demonetization. So it's unlikely that, we will see too much of NPA stress, largely in the public sector space. But clearly the retail focused banks might see a little bit of increase in the near term. But, that would last only for a quarter or so. So I would rather use, this correction which is happening probably to look at some of these names, which are coming back to long-term averages on price to book multiple. Clearly NBFC is trading at 6 times price to book was untenable. So, obviously the correction is going to be sharper.
With crude prices going back to 50-55, would you start to worry about some of the companies that have huge exposure to crude in terms of their raw materials? They've got re-rated quite a bit. So you would just want to see the impact?
Well, see, in terms of crude price, now the Indian economy is little bit more insulated because there's a general pass-through of the price increases. So it will never come as a shock to the system. And fortunately, we have seen that most of the companies have been able to maintain or improve their margins despite low capacity utilization. So I'm just hoping that these companies will be able to pass on. So, an increase to $55-60 is not really a big worry right now. But if crude was to jump to $80 or $100, probably, we might have to have a relook on some of the names.
Right. In terms of oil and probably oil names, I know you cannot talk about stocks, but, names like Reliance, names like ONGC, which are beneficiary if oil prices actually go up. That is something which you would start to look, maybe even a Kane India, HOAC. So companies that produce oil or get benefit out of better oil prices. Would that now be an overweight in your portfolio?
Well, see, clearly oil has been one of the massive underperformers in the commodity basket. And it's now starting to catch up a little bit. And, the news coming out of OPEC was also kind of positive. So I think this should support some of these oil companies, and so a little bit of weight increase, can be done. But see, these are very small weightages in the whole system. So for a company like Reliance, I don't think it's going to be a big kicker. But for other oil companies, I think it's still a massive increase.